Good morning. Have you ever wondered if you and your spouse can both take advantage of a solo 401k? Imagine doubling your retirement savings power as a family while still enjoying all the tax benefits and investment flexibility. That's what we'll be exploring in today's session. So today's topic is, can both spouses have a solo 401k plan? The quick answer is yes, provided certain requirements are satisfied, and we'll be talking about those requirements. During today's session, you can also ask questions by typing them over on the live chat. We'll answer those questions as they come in. They don't have to be specific to today's topic. They can be regarding IRAs, solo 401ks, business financing 401k, and even traditional 401k plans. Please also like today's video, subscribe to our YouTube channel so that you receive notifications when we go live. You can also visit our YouTube channel and access our video catalog. We have over 900 videos there covering all aspects of retirement accounts. You can also visit our community where we have over 30,000 members. If you're a financial professional, tax advisor, CPA, insurance agent, real estate broker, really any type of business owner, you can also post guest blog posts on our community so that you can flex your knowledge and present your work to 30,000 members in our community, and they can visit your website. So you'll be able to link your blog post back to your company's website so that our members can review your services, and they may even reach out to you if they see something that it would be beneficial to their business or even their financial planning. Also visit our artificial intelligence site, which is www.solo401k.ai. Take a look at that. Again, today's topic is, can both spouses have a solo 401k plan? Let's get started and go ahead and type over questions you have, and we'll pause and answer those questions as they come in. So we get this question quite a bit. So again, yes, both spouses can have a solo 401k plan, and they can both participate in the same solo 401k plan, provided certain requirements are met, and we'll talk about those here in a little bit. So many married business owners ask that question. Can we both participate in the same solo 401k plan? And the answer is yes. Therefore, you can essentially double up on your annual contributions to a solo 401k plan. For tax year 2025, for example, the overall contribution limit for those who are under age 50 is $70,000. And if you're over age 50, you can even contribute more via catch-up contributions. And if you're age 60 through 63, you can even contribute a super catch-up amount. So you can see how you can quickly double up on contributions when both spouses are self-employed. So you can really maximize those contributions, and you can make them as pre-tax contributions, therefore reducing your taxable income for the year, or you can even make them as Roth contributions or even as voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. So there are a lot of advantages when you're married in the tax code, including solo 401k plans. So what we're going to cover today is who qualifies as a spouse participant. We're going to cover all these topics here. So with respect to who qualifies as a spouse participant, Let's talk about eligibility for a solo 401k. So in order to qualify for a solo 401k plan, you have to be self-employed, and you cannot employ any non-owner full-time W-2 employees. Now, your spouse can participate in the plan if he or she is also working in the same business. So even if your spouse is not an owner in the business, your spouse can still participate in that same solo 401k plan, provided he or she is working in that business. So you would both need to be working under the same self-employed business. For example, let's say you have an LLC taxed as an S corporation. You and your spouse both work in that same LLC. Let's further assume that you both want to contribute to the solo 401k plan. Therefore, there would be just one solo 401k plan. If you look at the image on the right here, this is a two-participant solo 401k plan. So that same example, an LLC taxes an S corporation. Let's say Nate and Sally are both self-employed under the same LLC taxes an S corporation, and they both want to participate in the plan. Because the solo 401k plan is sponsored by the self-employed business, that would result in just one solo 401k plan. Because both spouses, Nate and Sally in this example, are both working for that same LLC. You can further see that each of them will have separate bank or brokerage accounts known as holding accounts under the solo 401k plan. So one plan, but separate holding accounts for each participant, because a solo 401k plan is a defined contribution plan. Therefore, the regulations call for having to track each participant's funds in the plan. So both spouses are participants in the plan. And also, if both spouses plan to make pre-tax solo 401k contributions, Roth solo 401k contributions, and voluntary after-tax solo 401k contributions, you have to segregate and separately track each participant slash spouse's funds under the plan. Hence why this image here shows a total of 6 holding accounts, aka bank or brokerage accounts. So it's not 6 separate solo 401k plans, it's one plan, because again, the solo 401k plan is sponsored by the self-employed business. In this case here, Sally and Nate's LLC. So one plan with separate bank or brokerage accounts to hold their respective source of funds. So it's not 6 different solo 401k plans. It's not 6 separate solo 401k employer identification numbers. Instead, is one employer identification number, EIN, that is, for the solo 401k plan. Remember, a solo 401k plan is a retirement trust, therefore it requires its own separate employer identification number. You cannot use your social security number, nor can you use your business EIN. When those solo 401k bank or brokerage accounts are open, they're going to need to be open in the name of the solo 401k plan using the plan's EIN number. Also, that employer identification number for the plan is important when you start to make distributions from the plan. Let's say you're age 73, and therefore you have to start taking required minimum distributions. The Form 1099-R has to be issued to report that distribution, and the EIN number for the solo 401k plan gets populated on that Form 1099-R. Same thing with conversions. Let's say you each want to process a mega backdoor Roth solo 401k conversion. Well, you would make the voluntary after-tax contribution to your respective voluntary after-tax solo 401k bucket. So this bucket right here, and then it would get converted to the Roth solo 401k or to a Roth IRA. That's going to require the issuance of a Form 1099-R to report that conversion. So whether it's taxable or not, it's still reportable on that Form 1099-R. Now, here in my solo 401k financial, we'll issue that Form 1099-R at no additional cost if you timely request the issuance of that Form 1099-R. And we'll even file it electronically with the government. A lot of other providers out there will not do that. They'll just tell you how to complete it, which means you're going to have to contact the IRS. They have to send you a certain document, a Form 1099-R document. It's a carbon copy that you got to physically fill out and you got to mail it back to the government. Well, here at my solo 401k financial, as long as you timely request that, we're not going to charge you additional fees for that service, and we'll file it for you with the government, so you don't have to finagle with having to order it from the government, fill it out, send it out. So again, if both spouses are self-employed in the same business, that means that both spouses work for the same business. It's going to be just one solo 401k plan because the plan is sponsored by the business. But each spouse will have separate bank accounts, aka brokerage accounts, or even holding accounts under the plan to hold their respective funds. And so that's the eligibility requirements. So as long as your business does not employ any non-owner full-time W-2 employees who work 1,000 hours or more in your business, or for that matter, any business that you control, then you can open a solo 401k plan. And if your spouse also works in the business, he or she doesn't have to be an owner because of the spousal exception, but he or she does need to work for the business in order to contribute to the plan, and the contributions are going to be based on your respective self-employment income from that business. So back to my Nate and Sally example, where you've got an LLC tax of an S corporation. We talked about how the LLC would sponsor the solo 401k plan. Well, fast forward to making contributions. With an LLC taxed as an S corporation, contributions will be based on your respective W-2 wages from that self-employed business. So Nate and Sally will need to each receive a W-2, so they're both going to have to work for the business because their contributions to the solo 401k plan will be based on their respective W-2s. So Nate will need his own separate W-2 from that self-employed LLC tax and S corp. Same thing with Sally; she'll need her own separate W-2, and their contributions will be based on their respective W-2. So let's say Nate receives a W-2 for $100,000. His contributions to the plan, whether he's going to make voluntary after-tax solo 401k contributions, Roth solo 401k contributions, pre-tax solo 401k contributions, whether just voluntary after-tax or a combination, those contributions are based on his W-2 wages. So if he pays himself $100,000 of W-2 wages, one example is he could contribute 25% of the 100,000 gross one W-2 wages as an employer contribution. So you do the math, 25% of 100,000 is $25,000. He can deposit that as an employer contribution to the pre-tax solo 401k, and that'll reduce the LLC's taxable income on the business side. So that can be deposited to the pre-tax solo 401k bucket or the Roth solo 401k bucket. Yes, you heard that right. Secure Act 2.0 now allows you to contribute employer profit sharing contributions as Roth solo 401k contributions. So let's say that he makes that 25%, so that $25,000 as an employer contribution. He wants to make it as a pre-tax contribution, so he would deposit that into the pre-tax solo 401k holding account, for example, bank account or brokerage account. Let's say he also wants to make an employee contribution, and we're talking about 2025 figures. An employee contribution is a dollar for dollar calculation. It's not a percentage base. So the employer contribution, aka profit sharing contribution, is always percentage based. It's 25% if we're talking about an LLC taxes an S corporation, and that's the example we're using here. So we'll stick with that. So 25,000, Nate will put into his pre-tax solo 401k bucket as an employer contribution. He also wants to make an employee contribution for tax year 2025. He can choose to make that as a pre-tax employee contribution or as a Roth solo 401k contribution. Let's say that in this example, he's trying to minimize his taxable income for the year. So he decides to contribute that 23,500 employee contribution to the pre-tax bucket. So that way he can get a deduction on that contribution on his Form 1040 personal tax return. So let's do the math. 25,000 plus 23,000 is what? $48,500 based on $100,000. So now Nate has thus far satisfied his employer contribution of $25,000, his employee contribution of $23,500. Now let's say he wants to also make voluntary after-tax solo 401k contributions. Nate is going to be able to make voluntary after-tax contributions up to the overall limit for the year. So for tax year 2025, the overall contribution limit to a solo 401k is $70,000 if you're under age 50. And we're assuming here that Nate's under age 50. So we're going to subtract 48,500 from $70,000, and the difference is the amount that Nate can make as a voluntary after-tax solo 401k contribution for tax year 2025. So I'm going to have to break out my calculator here. I know it's sad. I can't even do basic math anymore without a darn calculator. So 70,000 minus 48,500, that's $21,500. So Nate can contribute $21,500 to his voluntary after-tax solo 401k bucket and then convert it to the Roth solo 401k. That's known as the mega backdoor Roth. He cannot contribute anymore because the overall limit is $70,000 and he contributed to all three buckets. He made employee contributions, employer contributions, and voluntary after-tax solo 401k contributions up to the $70,000 limit. So one thing to understand is that in order to contribute to a solo 401k plan, you have to have earned income from self-employment activity. You can't just say, well, I've got some funds over in my savings account or personal brokerage account. Even though I don't have the required earned income from self-employment activity, I'm going to try to shift those funds over into the solo 401k. That's not allowed. You need to report the necessary self-employment income to support that contribution. That's why we use the 100,000 of W-2 wages example here. So it takes earned income to contribute, whether it's employee, employer, voluntary after-tax contributions, a mixture. Now, Nate could forego making employee and employer contributions and choose to solely make voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. And the mega backdoor Roth strategy involves making a voluntary after-tax solo 401k contribution and then immediately converting it to the Roth solo 401k or the Roth IRA. You want to convert it immediately so that there are no gains. Because when you convert those gains to the Roth solo 401k bucket or to the Roth IRA, those will be taxable. The basis obviously will not, because voluntary after-tax solo 401k contributions, just like employee Roth solo 401k contributions, are not tax deductible, so they don't reduce your taxable income for the year. So let's say that he chooses to only make voluntary after-tax solo 401k contributions. Well, it's a dollar for dollar calculation, so he can contribute $70,000 to the voluntary after-tax solo 401k converted to the Roth solo 401k. Now he's indirectly deposited a total of $70,000 into his Roth solo 401k. That's what's referred to as the mega backdoor Roth strategy. Now, if Nate was doing some planning and he just wanted to make voluntary after-tax solo 401k contributions, then he could control the amount of W-2 wages that he receives from his self-employed business. He could pay himself just $70,000 instead of $100,000 of W-2 wages. Why? Because the mega backdoor Roth strategy, again, consists of making voluntary after-tax solo 401k contributions, and it's a dollar for dollar calculation. So if he just pays himself $70,000, he can contribute that entire $70,000 to the voluntary after-tax solo 401k and then convert it to the Roth solo 401k or the Roth IRA. So the reason he would not want to pay himself more than $70,000 is because of payroll tax. He wants to save on payroll tax, and maybe he doesn't want to pay more taxes to Uncle Sam than he needs to by taking W-2 wages, because W-2 wages are taxed at the earned income level rates. Okay, well, so that's an example of, for Nate, Sally could do the same thing. The exact same example I gave, examples would apply to Sally, as long as Sally also receives enough W-2 wages from that self-employed business. What is more, I gave an illustration regarding an LLC tax of an S corporation. This same calculation can be utilized if your business is taxed as a sole proprietorship or partnership. What would change in the calculation, however, is that the employer contribution would be based on net self-employment income after you subtract 1/2 of self-employment income tax, and then you would multiply that figure by 20% instead of 25%. Whereas an LLC taxes an S corporation, when you're making employer contributions, so profit sharing contributions, because again, they're always percentage based, it's 25% of the gross W-2 wages versus an LLC versus a sole proprietorship or partnership where it's the figure after you subtract 1/2 of self-employment income tax from that gross figure, and then you can only multiply by 20%. So that's why it's typically more advantageous to have a self-employed business that's taxed as an S corporation, because you want to try to maximize your contributions to the solo 401k plan with as little income as possible. Because the name of the game when contributing to a 401k plan, especially a solo 401k plan, is to also balance the amount of earned income you pay yourself, because that's always going to be taxable to you unless you make pre-tax contributions. But even then, if it's not an LLC taxed as an S corp or an S corp, it's going to take more earned income to get to the same contribution figures as you would if your business was taxed as an S corporation. So we kind of jumped ahead. We just gave a really good illustration about making contributions when both spouses are self-employed in the same business. And we also gave the mega backdoor Roth solo 401k example here, where both spouses could effectively contribute a total of $70,000 to the voluntary after-tax solo 401k bucket, and then convert it to the Roth solo 401k bucket, resulting in a total of $140,000 indirectly in Roth solo 401k funds for the year. So talk about really supercharging your Roth solo 401k funds. Okay, it looks like we have some questions here. Let's take a look at some questions, and then we'll continue with today's topic, which is, can both spouses have a solo 401k plan? And you have found out thus far that yes, provided A, they're self-employed in the same business, B, that they both have enough earned income from self-employment activity under that same business so that they can really supercharge their contributions to the plan. Please also like today's video. Please subscribe to our channel so that you receive notifications when you go live. By liking today's video, that helps get the word out to other solopreneurs like you. So we really appreciate that. All right, let's see here. It might be 1 p.m. as the mice. Okay, it looks like we got a Matt said he had a 1 p.m. call today. So the 1 p.m., it's 1 p.m. Pacific time. It's not 1 p.m. Eastern time. So we are on Pacific time. Let me take a look at our calendar to see if your call was scheduled for 1 p.m. Pacific or 10 a.m. Pacific. So let's see here. Looks like it's 10 a.m. Pacific. So someone should have called you. I'm going to forward this over to someone on our team here. Looks like you had changed the time, so that may have caused some confusion. But give me a moment here. You may already be on the phone as well, but just to make sure, give me a moment here. Okay, so let's continue with today's daily topic, which is, can both spouses have a solo 401k? And again, go ahead and type over your questions during the live webinar, and we'll go over those as they come in. So let's pick back up where we left off. So we've been talking about the advantages already. We've talked about maximizing tax savings by making pre-tax contributions. We also talked about the mega backdoor Roth solo 401k strategy. We gave examples for both, and how you can double up on contributions when both spouses are self-employed in the same business. We already talked about who qualifies. We already talked about the contribution rules for each spouse. We talked about how both spouses can save a total of $100,000 for tax year 2025. We talked about the mega backdoor Roth and also the Roth 401k for both spouses, where they can both contribute to the plan. From a compliance rules perspective, let's talk about that a little bit more. We kind of touched on that already. But again, you have to make sure you're both working under the same self-employed business if you both want to contribute to the plan. So you both need to be self-employed under that same business. And again, if you both want to maximize contributions, you both need to have enough earned income from that self-employed business in order to make contributions. So keep that in mind, because the contributions to the solo 401k plan are going to be based on your respective earned income from self-employment activity. You cannot piggyback off of each other's earned income. So that's important to understand. And also, you need to have the necessary W-2 wages. If your business is taxed as a S corporation, or if it's taxed as a partnership or sole proprietorship, you have to have separate self-employment income as well. So bottom line, while both spouses can participate in the same plan, from a contribution perspective, you're each going to have earned income from self-employment in order to contribute to that solo 401k plan. And again, it's just one solo 401k plan. So we would only charge you one fee for the solo 401k plan. There are some providers out there that will charge you double setup fees, which is actually not even good, because they'll try to get you to open up two separate solo 401k plans for the same business. So let's say you have an LLC and you're both partners in that self-employed business. Some providers out there will say, well, you need to open up two separate solo 401k plans. So now they'll charge you double. Well, that's going to create a nightmare with the IRS. Not only is it costly, but it's going to create a nightmare with the IRS, because these providers also say that you're going to have to file a separate 5500 easy for each plan. Well, that's not right, because again, the self-employed business sponsors the solo 401k plan. So if you set up two separate solo 401k plans for that same LLC, that's going to create confusion with the government, which may prompt an IRS audit. Why? Because keep in mind, a Form 5500 Easy is an annual informational return that has to be filed for the solo 401k plan. Once the market value of that plan in whole is over 250,000 in value. And in the case of both spouses self-employed in the same business, that means you have to add both spouses' funds in the solo 401k plan to determine that $250,000 filing threshold. So if you set up two separate solo 401k plans for the same self-employed business, the IRS is going to expect that, one, you should only be filing one 5500 easy, because you're only supposed to have one plan. Second, you might think, well, I don't have to file a 5500 easy because my spouse's plan is under 250,000. Well, mine is under 250,000. Well, I've got news for you. That's not correct, because you have to segregate both of your funds to determine that $250,000 filing threshold. And then if you do file two separate 5,500 EZs, that's where the IRS is going to get confused, because they're going to say, okay, well, I'm looking at two 5,500 EZs listing the same self-employed business. Why are there two 5,500 EZs being filed? Well, because your solo 401k provider was trying to double up on fees, set up fees by charging you more money. So be aware of those providers that utilize that little trick to get more money, but more important, to create compliance headaches with the IRS for you. All right. So again, today's topic is, can both spouses have a solo 401k plan? Go ahead and type over your questions. If you have any questions surrounding today's topic, or any topic for that matter regarding solo 401k plans and IRAs, we're coming to the end of our session. So why does it matter if both spouses can participate in the solo 401k plan? Well, because you can both double up on contributions essentially by making contributions to the solo 401k. Again, for 2025, the overall contribution limit for each participant in the plan is $70,000. So if both spouses are self-employed in the same business and they both receive enough earned income from self-employment activity, they can effectively each double up on contributions by one spouse making $70,000 in contributions and the second spouse making another $70,000 in contributions, for a total of $140,000 in contributions using tax year 2025 figures. So again, the plan has to be structured correctly to avoid IRS regulation nightmares when you're opening a solo 401k plan for both spouses. Also, when you open up a solo 401k plan, the plan qualifies for the auto contribution tax credit. So you got to make sure you open that solo 401k plan with a provider who provides a plan that allows for the auto contribution credit. You have to have certain documents as part of the plan to qualify. And even though its reference of the auto contribution tax credit is kind of deceiving, because you don't have to make contributions to the solo 401k plan to qualify for the auto contribution credit. And it's a dollar for dollar tax credit equal to $500 per year for a maximum amount of $1,500 over 3 years. So it's $500 per year for 3 consecutive years. And again, you have to have a solo 401k plan, one offered by a company like my solo 401k Financial that has the necessary documents and language allowing for this auto contribution credit. And it's a dollar for dollar credit. And it applies at the business level. So it wouldn't apply to each spouse in the plan. It's at the business level. So a total of $1,500 across the plan. So $500 per year for 3 consecutive years for a total of $1,500. Here's some more information on that. So with this $1,500 credit, the cost of opening a solo 401k and maintaining a solo 401k plan is essentially subsidized by the government. The government probably put this auto contribution credit in place to encourage self-employed individuals to save for retirement. So, and what's great about the tax credit is that it's not a deductible expense. It's actually better. It's a dollar for dollar credit, which reduces your business tax liability on a dollar for dollar basis. So it's more favorable. Continue on with this auto contribution credit. Once it's added to the plan, you can opt out of having to contribute to the plan. So in other words, you don't have to contribute to the solo 401k plan in order to qualify for that auto contribution credit. You just need to make sure that the plan allows for it with the necessary language and the necessary attachments, and that you sign that waiver form. So you can, so even if you opt out of contributing, you still qualify for it, and you can still contribute at whatever amount you wish up to the overall limit, which is $70,000 for tax year 2025. And you're going to file Form 8881 each year to qualify for that auto contribution credit. So you would file, for example, Let's say you open a solo 401k plan for the first time in 2025, or let's say you have an existing solo 401k at a different company and you want to restate it to our plan, you would start qualifying for that auto contribution credit effective 2025. So you would file Form 8881 with your 2025 tax return that's due next spring, and you would claim a $500 credit on that Form 8881, which you would attach to your business tax return. You would file a second one for tax year 2026 in the amount of $500. So you would prepare Form 8881. It's a 2-page form. It's pretty straightforward to fill out. We can help you fill that out by providing you the necessary line by line as to where you have to fill out the information. So you would fill out a second Form 8881 for tax year 2026 to claim the second $500 amount, and a final Form 8881 for tax year 2027 to claim that final $500 credit amount for a total of $1,500. Now, if you're an existing client of my solo 401k financial, this credit wasn't available till beginning January 1st of 2024. So if you are a client of my solo 401k financial all the way back since our inception, which is 2009, all the way through December 31st of 2023, we can add this auto contribution credit to your plan this year so that now you could qualify for this $1,500 auto contribution credit over 3 years in $500 increments. Your plan would need to be amended. Let me send over a link where you can submit a support ticket if you would like to have this auto contribution credit added to your existing plan if you're an existing client of my solo 401k financial. Give me a moment here while I dig that up here. In the meantime, please like today's video. Please subscribe to our YouTube channel. We would really appreciate it if you like today's video to help get the word out to other solopreneurs like yourself. Please also visit our video library on YouTube to access past live webinars. And with regards, if you decide to use my solo 401k financial to open up a solo 401k plan, where whether it's just you participating in the plan or both spouses are going to be participating in the plan, you would go to our open account page. And to get started, once you fill out that online application, we're going to ask on that online application to list both spouses' names. But once you submit that online application, we'll typically have that plan ready for you to sign those plan documents the same day. As soon as you sign those plan documents, your plan is considered effective for tax year 2025. So as we get closer to the December 31st setup deadline, it's good to know that all you need to do is sign those plan documents by December 31st of tax year 2025 so that you preserve the right to both open up the bank accounts and brokerage accounts next year in 2026 so that you can make contributions for tax year 2025. You're going to be able to make both employer contributions and voluntary after-tax solo 401k contributions for tax year 2025 and 2026 by your business tax return due date plus timely filed extension, as long as you sign those plan documents by December 31st of 2025, and we'll provide those documents the same day. And then if you want to continue with the setup process, there are a few steps. Once you sign those documents, you upload them back to us, and then we'll get the tax ID number for the plan, and then we'll ask you whether you want to have the solo 401k holding accounts at your local bank or a brokerage firm like Fidelity or Schwab. So here at my solo 401k financial, we view this as being your retirement money. So therefore, you are the one that can choose where you want to hold your funds at. Other providers out there will try to hold the funds, or they'll push you to another institution that holds the funds. So here we let you choose whether you want to hold your funds at a brokerage firm, your local bank. So it's up to you. And we'll help you get that all set up. So again, thank you for joining today's daily webinar. We appreciate it. We're coming to the end of our session here. We'll be live again here in a couple hours. We got a question here from RJ. If each spouse has a separate business, do they each get $500 tax credit? Good question, and the answer is no. And the reason being is that now you've got the control group regulations that come into play, and you cannot utilize the auto contribution credit for both businesses if you are both self-employed, even in the same business or in separate businesses, because those businesses are under each spouse's control. So from an auto contribution perspective, you cannot double up on that auto contribution credit, even if you're both self-employed in separate businesses. That's a really good question. All right, again, thank you for joining today's daily webinar. Until next time, have a great day.